So I think from a structural perspective, not only in the short to medium term as we go into November, but really coming out of into early next year when the actual transition happens, we think there's going to be a secularly increasing volatility. Now, again, that doesn't mean the market's going down. That could be an acceleration higher for some period before maybe a decline. But broadly, volatility should increase.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. After a long slumber, volatility started returning to the financial markets over the past month. Why? And is this just a brief episode, or is this the start of a more turbulent era for investors? For answers, we welcome back to the program Jim Karsan, founder, CIO, and managing principal of Chi Volatility Advisors. Jim's also known as Jim Croissant on X Twitter. Hey Jim, thanks so much for joining us today.
Great to be here. Good to be back.
Hey, well, it's great to have you here. Yeah, you said good to be back. I know that you have been away on a bit of a sabbatical for the past several weeks. Very much appreciate you early on your return coming on this program, because I'm sure, as they always say, no good vacation goes unpunished. I'm sure it's a very busy time for you. But again, thanks so much for making the time to talk with us.
No, it's great to be here. Every time I leave, the world blows up, and true to form, it happened this time as well.
Yeah, it really did. All right, well, look, I'm looking forward to getting into your reasons why you think it did. And of course, volatility is your bread and butter. Before we get there, though, if we could just maybe kick the conversation off with the general starting question I like to ask, which is, what's your current assessment of the global economy and financial markets?
The global economy right now is stuttering. It's in the context of a greater couple of years of volatility. This has been a short-term reflation. We believe we're amidst a secular regime change, and I think markets are trying to figure that out right now. And with the election coming, this is a bit of an inflection point, I think.
Okay, so obviously, I guess the theme of that stuttering economy, meaning there's uncertainty in where the economy is going to be going, regime change, obviously a lot of uncertainty as to what regime we're shifting to. And of course, we've got the election coming up here. As I mentioned, volatility is your bread and butter there at your firm. What has sparked volatility to awaken with the strength that it did? Folks remember August 5th. And then we just had this past Friday, which some are saying was an even more volatile day. Why are we all of a sudden seeing volatility, after being dormant for so long, suddenly wake up like this?
So going into this summer, we were very adamant, based on supply and demand dynamics in the volatility markets, that we would have dramatic volatility compression and that dispersion would do well. Sure enough, it seems like a distant memory now, but May, June, July were historically very compressed implied volatility and realized volatility. Why am I talking about that? Because those moments are what lead to the extreme moments that we see afterwards. If you think about 2017, for example, the lowest realized and implied volatility in history, what was it followed by? February 18, what we now call the Volpocalypse. Those things are not independent from one another. Periods of low volatility breed excess leverage in short volatility products. They create dynamics that then can lead to extreme tail movements involve and expansion very quickly. We did talk even in May when we were talking to people that towards the end of the summer, that volatility would come back with a vengeance very quickly. And instead of starting maybe in September, it started a little early in August. But this is the way things work, and there are reasons behind this. This is not just cycles. If you look at the September quarterly, there's a reason why we have seasonality. People have postulated all kinds of different reasons why November and December are very strong and September's are weak. But in our world, a lot of it has to do, not all of it, but a lot of it has to do with the open interest of structured products and a SEP quarterly expiration following a lot of vol compression in the summer months in May, June, and July, and an increase of volatility that naturally happens going into the fall based on these structural dynamics in options and structured products. As that vol increases and people come back from vacation as well, they are forced to rehedge these portfolios, and that can lead to a lot of reflexive volatility in markets. And that's a lot of what we've seen now. It's not just that. Obviously, we saw a carry trade unwind and excess leverage in certain cross country dynamics and FX, and several other things as well that exacerbated the circumstances. And this one was a little bit unique, again, because it went early, because it went so early in August. It led to some, again, outsized dynamics that in markets that we haven't seen in a while. And I'd love to kind of jump into that a bit later, but that's kind of the broad overview. There's a lot of open interest in September OPEX and structured products there as a quarterly OPEX, and importantly, in an election year, there's very little supply behind it as well. And that's kind of, as we move through the summer, what eventually undid what was incredibly low volatility in a very fast way.
Okay, that's a great explanation. I am going to just let you run and roll up your sleeves and dive into the details of this, but just to clarify a couple of things. I kind of get from listening to you that volatility tends to be more like, a coiled spring, where when it gets depressed, it's there, it's building up potential energy, and then it sort of, gets unleashed in a quick, violent volatility spike, and then those periods are over very generally. So as you said, it's not kind of like a sine wave. It's more almost like a cardiogram, like a heartbeat, right? It's like low, low, low spike, low, low, low spike. Is that true?
That's a good way to put it. Low implied volatility actually begets more low realized volatility in general, but that lasts only for so long, and eventually that leads to a moral hazard where everybody starts selling vol because it's easy, and the returns are on a sharp basis because it's more of a tail strategy, look really great, and eventually that builds up so much risk, and the vol gets low enough because, again, it's reflexive, that eventually, like you said, it's like you get a heartbeat, you get a very quick expansion, and it's a coiled spring. So, but in the short term, usually it's one of the best times to sell vol, ironically, is when it's low and it's compressed. But that's also when the tail is the biggest.
Okay, and I guess that means, as an investor in volatility, if you're betting on higher volatility, you really have to get your timing right. Meaning, volatility can be low. It's low for much longer than it is high, right?
Correct. And you're talking about kind of in general, right? But then there's these dynamics which can really help you navigate that, which is understanding the supply and demand dynamics of that marketplace. And that's different than let's say stocks and bonds, because stocks and bonds are not just about who's long stocks or short stocks or bonds. There are different expirations, right, at different timelines and different strikes. So it's a much more dynamic, full 3D distribution, right, of positioning. And that allows for more concentrated positionings in times in the calendar and in moneyness. And if you can begin to understand what that positioning looks like in those supply and demand dynamics, you can begin to have a better sense of when vol may or may not be more supplied or in less supply, and where risks for its expansion or its compression may exist. And that's a big part of what we do and what we look at. And along with that broad understanding of the compression and the reflexivity of it, as well as this kind of spikes and how that happens, you can really pair that together to predict and get a better sense of when these things are more dangerous.
All right, that logic makes sense to me. And what I'm trying to do for folks here, just to help them understand, is, it sounds like if you're going to invest in volatility, it's a much more active type of investing. It's not a passive game. You're not just long vol and just let it ride over the years that you can with, say, an index fund that you're long in, some sector or something like that. So basically, I'm kind of making your firm's plug for you, but like, you want to, if you don't have a lot of experience doing this, you want to follow somebody who's an experienced active investor here to know when the conditions are right to be in, and obviously when the conditions are such that you probably shouldn't be long, right?
I think that's definitely true. I would add to that too, because of the convexity of options and these derivatives. It also makes that very important, right? These aren't linear bets usually that you're making.
Okay, yeah. So we'll get into the specifics of how you actually do this, and if folks are interested to sort of invest this way, what are their options? We'll get that in sort of in the second half of the discussion here. The other thing I just wanted to clarify, because I found it really interesting, is you say, you know, there are reasons why we have some of the seasonality in the markets, and the reason why September tends to be one of the worst months for the market on average is because it is coming off of a period of low volatility in the summer, and so therefore that's where we get sort of the heartbeat spike, right? And that's a very human dynamic, right? It's because humans are choosing to go to the beach, to trade less, or whatever. So it's just kind of interesting that you know, it's not fully, you know, macro or markets or equation related. I'm sure those all derive off of the trends, but the trend is basically just humans want to take a break, and so there's just less activity going on.
Yeah, that's definitely part of it. Part of it, though, is also the timing of why September, not let's say August or October, is because of other structural dynamics like we're talking about, like this quarterly expirations, which are mechanical, right? So there's a combination of those things. The other part I would add is there are other dynamics that are also less human. There are calendar effects on holidays. There's a ton of holidays in November, December, et cetera, which is really not for some specific reason. It's just, you know, that's Thanksgiving and Christmas and all these things fall and New Year's fall in that period. And so these structural effects also supply vol generally when it's not an election year in that back half of the year, which then also drives some of these dynamics earlier as well. So yes, some of it's human, some of it's just simply the way, you know, things are in terms of idiosyncratic things that happen in the calendar and supply and demand of structured products.
Well, again, and maybe I'm making your firm's case for it again here, but you know, it is a multifactorial soup, and again, it's not all the same types of things going into the soup. It's all different types of ingredients, some macro, some market, some calendar, some human, right? So basically, again, if you don't feel like you have a grasp on all the ingredients that are in the soup, you know, maybe work with somebody who's got a better understanding of all that. All right, so anyways, long story short, volatility seems to be here for the moment. The question is for how long do you think? Have we seen most of the potential energy already dissipate in the kinetic action that's happened so far? Or is this the beginning of a rockier period ahead? I guess we're at that point where you can roll up your sleeves and just explain away what you guys are seeing.
Yeah, so there's several pieces to this. You would expect volatility to increase out of the summer and broadly re-expand and loosen up because because pricing is now higher and it's not as easy to hedge. You'd expect more broad volatility as we go into the fall. That doesn't mean the market needs to crash or even decline in this period. You can have increasing volatility with an upward trending market. One great historical example is 98, 97, 98, 99, all the way to 2000, 3.5 years, we saw massive increasing volatility into the end of a rally. So just because we're increasing in volatility does not mean this market needs to decline. People usually equate the two things.
Right.
That's not necessarily the case. What is likely to happen is we're likely to see longer term volatility continue to trend higher, we believe. Now, that doesn't mean every week it's going to increase or every month it's going to increase. We're talking about broad trend. We are going into an election that has very, very, poor vol supply dynamics. There's a lot of hedging has happened there, and that means dealers and market makers are short that volatility, and it's quite high. There's a lot of uncertainty at that period. The effects for next year, depending on who wins, could be dramatically different in some ways. So those things should continue to underpin volatility. On top of that, the election's important because there are a lot of players who are not playing right now. When I say players, I mean geopolitically. What are nations looking to do? How are they going to react? They're waiting to see. Companies are not making certain bets or are willing to go in a certain direction with certain products to make partnerships because they don't know what's happening. So what happens as soon as that election ends, and we know the result, is an unleashing of different movements by different parties globally in different ways, right? Both corporations, governments, et cetera. That's naturally volatility increasing, right? We're going to see big moves, big changes happening after that. So I think from a structural perspective, not only in the short to medium term as we go into November, but really coming out of into early next year when the actual transition happens, we think there's going to be a secularly increasing volatility. Now, again, that doesn't mean the market's going down. That could be an acceleration higher for some period before maybe a decline. But broadly, volatility should increase. Now, that said, in the middle of that, between the election and before next year, there are some very important structural dynamics that people need to understand. End of the year is one of the most powerful seasonal periods. And again, those dynamics are structural. And I just want to reiterate, I've talked about this about once a year. We kind of talk about it. I think it's really important to understand this year in particular with the election in between a September and that really positive seasonal period. What are those dynamics? The biggest parts that underpin the strong November-December period is in an up year, assuming this market continues to stay up, we're up about 14 to 15% right now. There are massive reinvestment effects that happen at the end of the year. What do I mean by reinvestment? This should be Finance 101, but people do not get taught this. I think it's one of the most important things I try and get across to people is markets are managed broadly, not everybody, but broadly by entities, particularly hedge funds, risk takers, banks, managed risk neutral, not notional neutral. So there are $100 trillion plus of global equities. And there's another, think of it as 150 trillion, sorry, I don't know if I said million, 100 trillion, another $150 trillion of assets that are tied to equities. So when the market goes up 10%, you get a $250 trillion market that then goes up by $25 trillion. $25 trillion of new collateral. That's the creation of money. That's the creation of assets that didn't exist before. Now, to your average person, they think, oh, well, the money just went up in value, so everybody just has more money. There's not more money to go to work. You just own more of those things. But that's not how it works because there is a releveraging effect. Most bets are a function of leverage. So when you think about the bank, every bank, the whole system, most of the money in the system is leverage, right? It's all the bank can leverage its assets 10 to 1. A hedge fund does the same, right? So when that money goes up, all of a sudden there's a releveraging effect where that money puts more money to work. So there's a natural momentum effect, but that doesn't happen daily. That doesn't happen every hour. What that tends to do, I mean, some of it is daily, but what tends to happen is on monthly rebalancing when hedge funds need to rebalance or banks need to shore up their numbers, you get a reinvestment. Quarterly, this happens as well, but it also happens annually. And so some percentage of that reinvestment happens on January 1st. Now, what is that percentage? There's a whole range of predictions on this. It's very hard to judge exactly. But to be conservative, let's say the market this year is up $37.5 trillion. Now, if you get 10% of it, that's $3.7 trillion. You get 1% of that, that's $370 billion that goes to work the next day. When generally speaking, you have about 750 to 75 billion, very small amount, that moves markets on a daily basis. And so you're talking about a massive amount of reinvestment that's coming in. That's a major effect. So this is why first of the month when months are up, first of the quarter when quarters are up, first of the year are incredibly important positive periods statistically, and particularly the first of the year. So that's a very important effect. And in a year where we're up 15%, that's going to be sitting out there. We need to be mindful of that. As long as the market's still up. And if it's up more, that'll be even more powerful.
All right. So
Go
sorry,
ahead.
just to make sure I understood you, which is if we end the year strong, this dynamic is likely to make the market start strong the following year at the beginning of
No,
it.
actually, no, people are prepared for it coming in January 1st. So, and December 31st, it happens right at the end of the year. So there's entities preparing for it, getting out in front of it, that pushes the market up. So if
Okay.
you know somebody's coming to buy something on January 1st, what are you going to do? You're going to go buy in front of that known thing that's coming.
Great distinction. So
Yeah.
just to restate then, if the markets are up heading into the end of the year, you expect, I don't want to call it blow off top, but like you expect a real run up in the last part of the year as people front run that effect.
From this factor, yes. And this is part of why there is a 4-week period, which if you cut it and people, just it is by far, not even close, the most positive 4 weeks or full month of the year is actually the last 2 weeks of the year and the first 2 weeks of the year. And that 4 weeks, which we call the Santa Claus rally,
I was going to say, it sounds like you're defining
effect, these two things that people, you hear over and over, because people have seen the statistical anomalies. They're like, why does this happen? And people, attribute it to magical constructs like Santa Claus and some what other effect, right? But the reason this exists is because of this reinvestment effect. That is by far the biggest reason. Now, there's other parts to it as well. Okay. The other parts that matter at the end of the year is we have the least amount of what we call volume weighted time at the end of the year, from the middle of November till the end to January 1st. Really, actually, till January, we can get into some of the other expirational effects, but you also have MLK. Those effects, all those days dramatically reduce the amount of time in calendar days. But more importantly, because those are big holidays where people take time off, it also dramatically reduces the volume and the days around it. When you do a volume weighted time, you lose about 35% of time during that period. You lose a third of the time. Why does that matter? All these structured products, all of this of the things that are not just long stock, short stock, right? The market structure pieces, options, all these other pieces, risk assets, are actually also the biggest in December, because the December expirations, everything's issued at the end of the year, or at the December expirations for indexes, or for the January expirations for single stocks. And all of this skew and these things that we call Von and Charm effects, right? The buyback of all these deltas that are short against what's essentially a carry trade of short put, long call. All of that structural buyback that needs to happen gets accelerated. And it gets accelerated because time moves quicker and vol gets compressed from a very high level. There's a lot of skew, and all of these structural dynamics also lead to a massive buyback of stock in that period. In general, they tend to, right? Because of those dynamics. Now, there's always a fat tail out there on these. So you have to understand a carry trade, much like we just experienced, is generally works like 95% of the way in one direction. But when it breaks big, right? So these structural effects are incredibly strong in November and December into the last month and a half of the year, and then again into the beginning of January. And so you pair those with this buyback in an up year, and there is an incredible, lean to which way these flows are going and are likely to go. Right now, again, if the market drops and goes to down on the year from here, and that 20% drop, no, those things will change, right? There's a reflexive nature. The market's up, it's likely to go up. The market's down, it's likely to be negative, right? But as we enter that period and there's more certainty to where we'll be and what's happening, then there's also a chase, right? We've always heard about the chase. If people are underperforming and the market's going up and these structural dynamics are in place, what are you going to do? You're not just going to go get in, but you're going to go try and leverage these odds to try and catch up or to outperform. And so there's also a massive chase that happens into the end of the year, given these dynamics when they start going. And so it can be a very positive part of the year. And again, everything you haven't heard me say anything about geopolitics. You haven't heard me say anything about what's happening in the economy or anything else. These are structural things that you need to be aware of in a very kind of month and a half, 2-month period. And importantly, because they're structural, and I'll leave this here, once these things pass and they're gone, then it's back to reality. Then they become structural effects that have now passed in the context of a weighing machine that may have very different results. And that's why February in particular is actually the second worst month in history after September. is because after this very structural Santa Claus, January effect, all of this period in November, et cetera, that are also quite positive. Now you have this kind of hangover from the party, right? You have this period where all of a sudden markets have kind of run, not because of some reason other than just structural effects. And if there are reasons to be concerned, or if there are shifts that are happening that may need to that mean this rally was unwarranted, then it can lead to even worse volatility, because now you've lifted something further off the ground. You've kind of compressed things and created a more dangerous and dynamic situation. And so that's how end of the year seasonality matters. That's why February is a bit stronger. It's also a function of September on the other side. So these are things to think about from a timing perspective. So you asked me, what do I think things are going? Well, I think volatility is increasing. I think there's big shifts and potential problems on the horizon out next year. But between now and then, we have an election, and then we have this massive structural buyback machine that happens as long as this market is up. And so we're likely to get some volatility, some relief of this event vol in the November election, and then all these positive effects. But that's likely to then lead to some type of blow off top, some type of volatile last set of moves. And whether that ends in January or February, I think we're likely to see some real volatility at the beginning of next year, which I think is meaning middle of January through February. And I think that's going to be a very important moment for this market. And I think we're starting to see some structural dynamics with the AI names and bigger geopolitical issues as we approach that period that are giving us clues that probably sits out there for next year, despite likely a run against that, a counter trend move up that could be quite volatile between now and then.
All right. God, that's all.
Just gave you a lot.
No. You're giving us gold here. Okay, so I guess big takeaway for everything you just mentioned, you would not be surprised to see a strong end to the year. So the next 3 to 4 months to maybe be a little bit more volatile, but could lead, to your point, almost to like a blow off top in the markets. And then as we roll into the next year, heading into February, for some structural concerns, which we haven't really dug into much yet. So I'd love to let you enumerate those if you want to. You could see the markets, really getting, a lot rockier in February. Did I summarize correctly?
I think that's good. I make one adjustment. It could start as early as January. And
Okay.
I think the real positive effects really are into that second of January, right? You have some other underlying effects in the first week or two into middle of January. But by middle of January, by the end of, let's say, that January effect, that 2-week period in January, that's when the volatility can really begin. And it may not start till Feb, but there is the opening of this kind of window of potential risk really into the early moments of next year.
Okay, so to tie to the election, whoever gets inaugurated on Inauguration Day may have a pretty rough couple of first months in office.
I think that's very likely.
Okay, I got to say, Jim, it's fascinating. It's almost as if you have kind of a different pair of glasses than many of the folks I talk to. Not on the right or wrong side, but you're just looking at the market in different ways, and the logic totally makes sense to me. It's really fascinating. Let me just ask you one question, and I'm almost embarrassed to ask it because it's such a simple mode of thinking versus how you've been talking about. But I've put this idea out there just to get people's opinion on it, and I'd very much appreciate yours, given how you look at things. I can see, so you kind of have to buy into the thesis that right now the current administration is doing everything they can just to kind of keep things looking as good as possible heading into the election. I don't think it's a crazy thesis, because I think my assumption is almost any administration does that, trying to get reelected or their party reelected. We're certainly seeing, signs of some cracks, that things aren't as good as we've been told. And of course, if you're looking at the employment data, that's one really, I think obvious area of this right now. So my point is There's a lot of kind of extraordinary efforts being undertaken right now to keep things looking as good as possible. And I think they know that. So let's say that Kamala Harris wins the election. I can see her, team saying, "Hey, look, we can't be doing these extraordinary efforts forever because they're just not sustainable. Better we stop doing them now. Let the froth get out of the market. Yeah, we'll have a rocky first year, but then the dust will settle and we can finish strong, right? We can set the bar low so that we can clear it easily in years 3 and 4 of our administration, look good coming into the next election." If Donald Trump wins, I can easily see the Biden-Harris administration saying, "Well, screw this. We're not doing anything. We're going to let this whole thing just, whatever. It's his problem now." Right. And I could see Trump saying, "Fine. Yeah, I get to blame it on you for the next year and a half." And then it'll set the bar low for me. And then I can finish strong in years 3 and 4. This is a much more sort of human, logic approach. But what do you think about this? Is that just too simplistic logic, or could that be a factor here amidst the other things that you're talking about?
I think you're touching on some very important dynamics. I'm going to zoom out for a second and add some color, some actual numbers to a couple of the things you're talking about. If you look at election years going back to 1928, so a long, big data set, people always point to it and say, look, the average performance of the S&P 500 during election years is 12.5%. It wins 75% of the time, I think is about the stat. Very positive historically. But what people don't note, and I think this is very important, is if you take, this is not cherry picking, by the way, you take the periods the one period, I guess I should say, where it was very populous during that period. What is the most populous period during that point? This very important 62 to 82, that 20 years, right? This period where we really had a lot of the only period we have really secularly increasing interest rates, a period where we have the Great Society program, and we have a significant amount of protectionism, global conflict, a lot of things that you could argue we're seeing now, which is our opinion. If you take that one period, and this is really interesting, and you look at all of the elections that happened during that period. So we have, we have working backwards. We have 1980, we have 1976, 1972, 1968, 1964. So 5 elections. Every single one of those was up double digits. And the average performance of those was 21.5%. So we go from being a slightly positive, 80, 90 years, 190 years of history, relative to history, to an incredibly much higher. And if you take that 20 years out, the average period, the average performance of the election is actually only 5.5%. So it's actually way under. Why am I pulling that out? I mean, that seems kind of odd. Well, what happens during populist periods? Well, if you look at the elections over that period, you switch presidents every single time except once. And Nixon actually got kicked out, right? Because of, again, very confrontational. People are unhappy with government. The average person feels like the system is unequal and hasn't been working for them, particularly the youth and who has been labor for the 20, 30 years leading up to that, and are frustrated by the way the system works. Does any of this sound familiar? So you had a constant back and forth and changing of elections. And because of that, because they're very contested, you have these administrations trying to juice the market into each election and succeeding largely for that election. Okay, we saw this again and again. We saw it with, LBJ. We saw it with Nixon. We saw it with Ford. We saw it with Carter. We saw it, all the way up to Reagan. So now let's back up now to that period. How did markets perform? If you think about that, we have 5 years. Each one was an average of 21.5%, up, each one up more than double digits in an election, like incredibly positive data set. How did the economy, how did the market, I apologize, do from that during that period though, broadly? It's the worst performing market in history over a longer period of time. So if you take out those 5 elections now, for that, I mean, let's take a subset that I've talked about the most, 68 to 82, which is all but that first 4 years.
Mm-hmm.
The market went nowhere in nominal terms, and in real terms, which is what really matters, lost 70% of its value over 14 years. Yet 4 of those elections, four of those 5 elections fall in that period and averaged 21.5% during that period. So sorry to
interrupt. I just want you to address this in your awesome continued answer. So are those administrations that are running for re-election, are they essentially just sucking all the returns from future years
100%
into today?
It is not about good policy. It's about what keeps the plate spinning for that year until they get elected, or they try and get elected. For the most part, they don't get elected, by the way, which is an interesting kind of side note.
So another way to think of it is they are writing the check for their immediate benefit. And maybe it works, maybe it doesn't, depends on how the election goes. But the person who's actually paying the bill is all the rest of us later on.
Correct. Which is not new, by the way.
It's not new in politics. Yeah, exactly.
In politics, but to the extent that it's happening in those periods, and the need to do it based on the contested nature of those elections, A, and B, the populist fervor of the people during that period. So you have to give them what they want, otherwise you're not going to get elected. Importantly, you take those 5 elections out, and we go from an awful data set of the worst period in history to an incredibly abject, without those 5 years, that 14 years of history, those other 9 years are on average down 10%. You're talking about a decade of returns of down 10% nominal terms, and compounded in real terms a 90% worse, 90% decline or worse over that period. I have to go look at the exact numbers, but wow. It could not be worse. And the consistency of the elections in that period and the size and scale of the success during those periods relative to how poor that period is otherwise is really pops off the page. It's hard to explain other than this simple fact. And I would argue, and this is a weird coincidence, maybe not, that in 2020, which I would argue is one of the first really big contested elections, market was up 21.5%, right in line with that average. And here we are in 24%, up 14%. And guess what? I venture to say we're going to end a bit higher than here again, in the context of, by the way, 22 was awful, right? And if you go from 20 to 24, how's performance been in real terms? This market has gone nowhere in real terms. Maybe even you could argue decline based on several different metrics.
Wow, fascinating. All right, well, thank you. Now I feel a little smarter in spite of myself, and also a little more depressed that yes, indeed, this is the pattern of history. All right, well, look, I want to get to the things that concern you most about why things could go wonky early in the next year and what you think the big issues to drop may be. Real quick, we are making the assumption, at least at this point, that the market does end strongly and has that ramp up right at the end that you're expecting. Just to make sure I understand, let's say the market let's say it's trending downwards heading into mid-December. Do the factors that you mentioned here, the massive reinvestments, the releveraging effects, et cetera, do they then work in reverse, or are they softening any downward movement in the market?
So it depends on the size and scale of that decline. If it will decrease with the decline between now and then. So let's say by mid-November, if this market has gone from up 15% to up 5%, let's say, then we will have significantly less effects in December, right? from that
you would
from that
expect still
reinvestment.
positive effects, but just much smaller.
Well, there's several effects, right? We're kind of generalizing them, but
Yeah, I know. Sorry.
the reinvestment effect will decrease meaningfully. And if, by the way, if it's down 10% by the time we get there, then they'll be negative. That part will be negative. But this vol passing, the vol compression, this high skew and structured product, that pulling forward of that buyback will still be there. And you could argue might even be bigger because the skew and vol would be higher and there's more effects. So there's multiple effects. It's not just black and white, but broadly, that momentum factor, which is the reinvestment effect, which a lot is very important because then as long as that's sitting out there and people know it's out there, then that actually helps compress vol and pull forward the other effect as well. They affect one another. So, so the more that pulls off the table, the more likely there is to be expansion in volatility and less odds there are of that buyback. So, important to watch. This is not a right now telling you up or down. This is not much of what we talk about. It's multidimensional and it's true edge. It's true. It's important to understand these dynamics so you can react accordingly as the market follows the if-then of these if-then statements. But sitting here right now, we have to see what happens first to figure out what the next part of that node of that decision tree is. That said, so right now, this is the time where volatility is here that you'd expect, where the real risk in the market lies, because we're still a bit further away from that. And between now and the election is really the time where things can get volatile and negative. If they don't, you have to be very positive into the end.
All right. Well, Jim, we're talking here in relatively early September. If we can just kind of make a date now, let me invite you back on the program mid-November-ish or so, if you have time in your schedule. Would love to get your update then, once a lot of the uncertainty has been removed and you have a much stronger sense of where we are going into the end of the year.
I always love having these conversations. I'd be happy to come back.
All right, fantastic. Because I just had to interject that because I'm sure that was on the minds of everybody watching as you were speaking there. Okay, so let's two main last things. Then anything else you want to talk about as we begin to land the plane here slowly. Let's talk about those shoes that you think may drop early next year. Like what are you most concerned about when you talk about the fact that we may have kind of a bumpy ride to the start of the year? And then lastly, given everything you've just told us, what counsel do you have for the regular investors watching in terms of how they might be able to play these end of the year dynamics? And then, I'm presuming assuming things are playing out the way you think they will, what you think they should do going into the start of next year. And I'm going to assume you're probably going to say get pretty defensive for that answer, but I'll let you answer that when we get there.
Absolutely. So it's no mystery or that the economy has been slowing, right? It's been gradually happening for some time. We originally had early this last year, some speculation that we might go into recession early in the year. And then the Fed brought forward pretty dramatically and surprised the market last December with this prospect of 6 cuts. And the second they said that, what happened? The curve adjusted, right? And the cost of money got cheaper. It's not like the market had to wait for those cuts. It priced those cuts in. And the pricing in of those cuts provided a very quick, big stimulus to the market.
Sorry to interject, but which is amazing because, we're coming up on 9 months more, 10 months after that. They got this basically free effect in the market and they didn't have to do a darn thing.
Correct. And that's the beauty of, the bully pulpit or whatever you want to call it of the Federal Reserve. It's their speech matters more than what they actually do. Because once they do it, the market's already been priced in. And what matters to liquidity is not the Fed funds rate. It's what the 10-year is doing. Really. Yeah. And so they had an incredibly positive, and I would say asymmetric effect on the economy late last year into early this year. And that, along with, as we mentioned in the election conversation, a lot of other fiscal and a lot of other effects done by the Treasury have been able to increase and improve liquidity and push the economy back up. But the structural effects and the lag of these higher interest rates that take not months but years to kind of push through the market have been weighing on on the whole economy. And we've continued to see despite that initial push early in the year, the economy continues to kind of fizzle out a bit, right? And importantly, it's not just the U.S. economy. The U.S. economy has been keeping everything up, right? The U.S. economy is the one global economy that's really kind of allowed the things to, the game to keep going. China's been in an awful state, obviously. We can get to some of the other geopolitical things tied to China as well, which I think are important post-election. But there's, Europe, obviously, with the war and the issues that they've been kind of dealing with post-war, and not to mention other parts of Asia and South America that have been having issues. So really, this is the last thing, hanging in there. And the U.S. dollar strength, right, has been a function of all that money overseas kind of flowing into the U.S. as well, with the higher interest rates and the strength of the economy. Now, what happens when that goes into reverse, right? Are we looking for China to step in and their economy to come back and to save this market? Europe, right? So there's a real problem if the U.S. starts going into recession for earnings, at least, right? You pair that with we've been in a multi-year period, which we've called for since 2020, and we think this is a decade, plus 15-year issue, in a period of deglobalization that's tied to protectionism and populism. And that's not going the other way, whether it's Trump or Harris. The protectionism, it's really a battle to see who can be more populist and more protectionist at this point. And so our belief is that, as we get into next year, that's not going to go the other way. That's going to increase and continue, right? And whether it's a Harris administration or a Trump administration. On top of that, and I'll get to the China piece. I think we're starting to see some clues that, and again, this is every time I get on and talk about a impending China-U.S. conflict, people kind of roll their eyes at this point, right? Everybody thinks this is a low probability, high impact event. This is not a low probability, high impact event. It is a high probability, high impact event. I think if you talk, and I do talk to people both at major contractors here in the US, as well as people in the administration, the broad view is that there is a 50-50 chance that China moves on Taiwan in some form or another in the next 4 years. I think that's conservative by a lot of measures. So that means there's a high probability of a company which was not too long ago the biggest company in the world, NVIDIA, and an AI complex tied to that biggest complex in the world, which has been the only thing essentially lifting stocks, being at the epicenter of what could potentially be the biggest issue for markets in the next couple of years. If that is to happen, obviously. But this is a game of risk reward. And if at the end of the day, we believe there's a 50-50 chance of something happening in the next several years that would cut NVIDIA's production by 85% at the valuations we're talking about now for that name, and broadly what that would cause in terms of a bottleneck for any AI movement. What do you think that may do to the economy and the U.S. economy, not to mention the global economy? I think the fact that people are whistling by the graveyard on that. Now it's a quote unquote tail event, right? If it doesn't happen, then we can keep the plate spinning. But deglobalization and global conflict, we have seen year by year increase, not decrease, right? It's not that Russia, Ukraine has stopped. Right. That continued to go on, and now we have a conflict in Gaza. And the conflict in Gaza is intrinsically tied to what's happening in Russia and Ukraine. If you don't think it is, you're not looking at the big picture. Meanwhile, conflict on a Cold War basis between the US and China has only leveraged up again and again to the CHIPS Act, to all kinds of other measures, both on the Chinese side and the US. And so we were talking about this 2-3 years ago, and people were worried. People are kind of, again, whistling by the graveyard. I think one of the biggest issues that's sitting in this market underneath the hood right now is what happens after an election if, by the way, a Trump administration gets elected. And I think if you saw the beginning of the decline recently, by the way, it was the Wednesday of expiration in July that things really started to wobble. And what got hit? NVIDIA. What kicked that off? Nobody's talked about it. But it was Trump simply saying on that Wednesday that if Taiwan, right, wants to any help, they better start paying for their own defense. And that we won't go help Taiwan in that situation. Again, people will think I'm crazy in saying this, but the beginning of the NVIDIA decline, if you go look at it, is marked by that day and that comment. And I think the pricing of risk in those names has not been priced in appropriately yet. And I think the markets are pricing it in a bit more as we go forward here. And if that continues, given the risk that potentially exists there post-election, I think that's one also thing to think about outside of just the global economy and the building recession and earnings issues that we're seeing.
Okay. All right. Well, that is a very big risk factor should it actually come to materialize. Just to be super clear, when you talk about a worsening China-US conflict, is it more of the Cold War, trade war flavor, or do you actually have kinetic fears?
They're both on the table, right? And they both matter.
Okay.
I think the Cold War elements we continue to see and continue to cause major issues, the Chinese economy, right, which is affecting global trade, as well as I believe eventually will affect. We're all connected. We've all benefited from this globalization effect, and I think in the U.S. it will continue to be an inflationary factor more than anything. But it's really the connect piece that is less smooth, less more. The kinetic piece can become very, very tail in the market, and pricing that in the way markets price in these things is probabilistically times magnitude. And if we think there's a 10% chance of something and it's a 50% decline in NVIDIA or 70% decline in NVIDIA, depending on how you look at it, okay, that's a 7% correction in the price. But if it's a 50% probability and we're talking about a 60, 70% decline in the market, all right, we better get a re-rating of 35% in order in the short term. And that's kind of some of what we've been seeing. Again, I'm not putting all of our eggs, and the reason for a decline is because of this factor, but it is something incredibly important that we need to think about, given how important the AI space, and particularly NVIDIA, has become to this market, and not just the US market, but the global market.
Yeah. Okay. I want to talk about AI in just a sec, but real quick, your second trend there, deglobalization, protectionism, do you then lead from that to say that's going to have a secular inflationary effect going forward?
It already has, and yes, I think the deglobalization effect is the biggest inflationary pressure that we see, not just because of what it means in terms of not being able to import cheap goods anymore. It really creates a lack of labor supply broadly, and we are now limited in the U.S. and the developed world by people who are disjointed from the pricing of the market in terms of what they demand in terms of producing our own means of production.
We have an older and more expensive labor force, and it's just, if we want to have those people do the work, it's going to be more expensive.
Right, and the labor issues we've been seeing. So we look at unemployment and we say, oh, unemployment, like, not that bad, things have been great. Well, but the problem is what kind of jobs are we adding? We're adding low-end jobs that were once going to China in a lot of ways. And then we're getting, and the higher paying jobs are actually declining. And so we're getting a lot. This is the rebalancing we've talked about. We've had a massive populist push because there haven't been the ability for certain people to get ahead because manufacturing for 40 years has gone abroad. And this is what, this is why Trump is talking about rusted out cities in middle America, and why the Bernie Sanders and AOCs of the world are saying the same thing. It's popular because it's true. People on the bottom, and particularly the youth, have underperformed for 40 years. But if we're going to fix that, if we're actually going to address that, if we're going to put up walls and say, okay, we're not doing this anymore, it's a different world, and profitability and margins compress dramatically, right? And the flow of money dramatically reduces as well, which is a hard game for the Federal Reserve to manage.
Right. And there are there are benefits that come from this too, right? So, we may take some hit to corporate profitability. We may have some benefits in national security and employability, and I'd actually love to discuss this in more depth with you, Jan. We don't have time to do so this time around, but maybe next time. But as you're talking, I'm kind of hearing, some echoes of Ross Perot, basically saying like, hey guys, I kind of told you you'd get to the stage at some point if you went down this route, right?
We can either maximize median outcomes or mean outcomes. And those sound like very similar things. They are so different.
Totally different.
Economic outcomes are dramatically different. And we've chosen to optimize to GDP or mean outcomes.
Yep.
And meanwhile, we've hollowed out our middle class. And the question is, what do we want? What do we want? If we want to maximize median outcomes, well, guess what? There's another cost to that, which is a slower, growth environment, broadly poor corporate profits. But maybe we're all kind of broadly, more people are happier and better off, and that's a big question.
I love that you brought it up that way, because I talk a lot about the importance of having to understand the difference between mean and median when it comes to a lot of these economic issues. So anyways, I didn't think I could like even more, Jim, but you just managed to do it. All right, well, look, we got to start wrapping up here. I do want to get to the key question everybody's, leaning in on, which is, all right, so what does Jim think we should be doing here as investors? Real quick, I'll just take a quick answer on this with AI. So you just unveiled like an almost existential threat to the AI sector right now. Let's all cross our fingers and hope that it doesn't get to that level. But even forgetting about, putting that aside for a minute, the whole China, Taiwan potential snafu, there's, I think, growing concern that a ton of money has been getting spent on AI, and we're not necessarily seeing a lot of direct, certainly not incremental revenue come off of it yet, and maybe even enough incremental profits coming off it yet to justify the immense amount of spending that's been done in such a short period of time, which has driven the valuations of these stocks to the moon, right? So, there are people who are raising the question of like, could corporate America say, hey, look, we're going to take a beat, and we're going to start reducing our spending here until we see some of this return. And I think a lot of people are just saying at a high level, look, this might not be that dissimilar from the internet, right? Where it actually did end up delivering on all the promise and unlocking of new value it said it was going to, but it took a couple of decades for that to fully be realized. And all those crazy valuations we got in 99 and 2000, were just too much too fast, and we may be having the same thing going on here. How much of a risk do you think lies there?
Irrational exuberance, right?
Yeah.
This has happened before. If you've been around long enough, you've been through it. Did the internet matter? Yeah, the internet changed everything. But did that stop the tech bubble from bursting, and for 97% of all internet companies from going bankrupt? No. It takes time. It takes capital. It takes a lot of investment for these things to come to fruition. And by the time they do, who profits from it and how much may be completely different than what people thought, at that time. Again, if you got the 2 or 3% of internet companies that survived, you did very well with them, but you better have been in the right ones.
Right. And you might have had to wait a while to get your long-term return, right?
Correct. And so the risk reward, right, which is always what we're talking about, is important. And it's important to look at the whole scope. It's not just about whether AI matters, it's going to change the world, right? It's about how much money is going to be made on it, by who, and under what circumstances. I can argue that the benefits of AI may not accrue to AI. The benefits of AI may accrue to energy. The benefits of AI may accrue to data sets. And AI may just be a commodity, which is largely where it's going. But we don't know. I'm not saying that's the case. Any number of things can play out of this. And so I think we're way ahead of ourselves on all of this. If you just go back a couple of years, it's hard to, we're so short-sighted. In 2022, NVIDIA was left for dead. Why? Because the same kinetic issue we're talking about just now that people have forgotten about, which people were worried about China moving on Taiwan. And so they literally left NVIDIA as like uninvestable for some time. And then all of a sudden, everybody forgot about it. ChatGPT came out, and then, the rest is history. I would argue that, the short-term investment cycle and everything that's going into those names is important, and the earnings matter. But valuing it as the largest company in the world, especially when we're the volatility in that name, which has been 35. We've had a 35% drop, followed by a 25% rally, followed by now another 25% drop, is wild. And I think on a risk-adjusted basis, the upside of the largest company in the world becoming the largest company in the world by now 50% or 100%, relative to the potential existential risks and the long-term potential problems there, does not weigh the investment that we're seeing. And I think if that's what we're depending on leading this rally from here, I think there's a lot of problems in that.
Okay. All right. Well, we're here at the end. For folks that are saying, okay, Jim's a smart guy. I think he's got his finger on the pulse. Looks like we're gonna, unless things take a deviation, probably going to end the year strong. Maybe have this end of year run up, then a rocky start to next year. What are some ways people could consider playing this?
So we have a wealth advisory service, and what we do for our clients broadly is we're not betting in this decade, not just this year. We're not betting on this decade on beta, right? This is not the decade of 60-40. That was the last 30 years, and everybody thinks because 30 years is a long time, that's just how you invest for the long term. But what people have lost sight of is that interest rates have secularly decreased from 20%, had decreased from 20% to zero over that 30-year period, which is what made 60-40 work so well. And then all of the wealth advisory services, everybody out there just says, because it's low cost, well, this is the way to invest. If we go look back at the last time interest rates went from bottom left to top right and increased, that period 68 to 82, like we said, we not only saw in real terms a 65% decline in equities, but obviously being in bonds at a 3-4% rate 10 years out, when interest rates went to 20 was incredibly painful as well. So I don't think you need to take that risk. We're not saying that we're going into hyperinflation, but if you think the odds are higher of an increase of interest rates relative to a decline at this point, secularly, I think it pays to not be, especially at these valuations, in beta. So how do you do that, right? Everybody's like, how do you invest in any other way than just stocks, long stocks and long bonds for the long run? Well, there's a lot of opportunities, and a lot more than the last time this happened in the 1970s. Now you have things called derivatives. Derivatives were created in the 70s for their capital efficiency, right? They allow for positioning without the actual dedication of capital, which allows you to get the yield that the government is giving you out there or other yield products are giving you in the short term, right? Without, you can take that yield without actually outlaying in the capital and still get positioning. So there are ways to go out there and get secular returns in a non-correlated way. It takes a little bit more work than just going and buying stocks for the long run or going and buying bonds, a 10-year, 30-year bond. But there are ways to do it. You can do some yield stacking, which is essentially taking that T-bill rate, that short duration bond, and then stacking with that collateral, several percentage more with things that are very conservative on a cash secured put, cash secured call, other type of things you can do there. There is an alternatives, much bigger alternatives bucket now available. When I say alternatives, I'm not talking private equity. I'm not talking venture capital. I'm not talking real estate. In our book, those aren't alternatives. Those are all in a form beta. They're all tied to the market performance. I'm talking non-correlated strategies. We have any number of things, event-driven, macro. We can go through distressed, both on the credit side and the equity side, long, short equity, long, short credit. I could go on long volatility, neutral strategies. There's any number of these strategies. And this is why you're seeing the Millenniums and the Citadels and all these other hedge fund structures doing so incredibly well during this period. They should continue to do well. The dislocations that happen during these periods and the ability to take advantage of the efficiency of capital with derivatives is an incredible opportunity. So that should be more like 30% of a portfolio, we believe, and it should be diversified in a non-correlated way. Lastly, invest in the economy. I'm not saying don't buy companies. I'm saying don't go passively invest in the stock market. There are companies out there that will do incredibly well, that did incredibly well 68 to 82. If there's secular pressures in this system, which there are, and there are major shifts going on underneath the hood, that means there's more opportunity than usual. And you're going to see more rotations. We are seeing them already. You will continue to see them. And we believe those are structural elements that will allow for profitability. Follow Warren Buffett. Look at the value approach to investing, which has not been that successful the last 30 years. That will work. Cash flow will matter. And ultimately, you should be doing that with about 40% of your investment. And again, focus on government funding. There's going to be a lot more government funding of investment than there is capital market funding. You're going to be, defense should do very well, healthcare, infrastructure, urban housing and development, and go down the budget of the US government. And that's where the mouth of the fountain will be. So there is a lot of opportunities in onshoring, nearshoring, government-focused investment. Again, we can go on in commodities, which were 35% of the S&P 500 in 1982, and now 3%. There is a tremendous amount of opportunity, but you have to be in the right type of things that really yield cash and that do well in rising interest rate environment. So we'll leave it there, but there's a tremendous set of opportunities, but you need to be willing to step away from 60-40 buy and hold. If you're burying your head in the sand right now, 10 years from now, you will likely regret it.
Well, all right. Well, look, you gave an awful lot of material for folks to look into there. Jim, thank you so much. All right. So for folks that have really enjoyed this discussion and found a lot of value looking through your lens at the world and the markets here, Jim, where can they follow you and your work?
So kaivolatility.com is our website. You can go on there, request a meeting. We also do a blast about once a week with all of our recent commentary and write-ups at kaivolatility.com/news. You can subscribe on the website and of course on Twitter/X at jam, JAM_croissant. For our French speakers, you can follow me on there. We usually like to post once every couple of days.
Great. All right. Jem, this has just been wonderful. Hey, when I edit this, I will put up the URLs to both your website and to your X Twitter handle up there, so folks know exactly where to go. Folks will also have the links in the description below this video, so you can get there with one click too. Jem, it's just been so wonderful. Thank you, folks. If you'd like to have Jem come back on again, as we discussed, at some point in mid-November, if that works in the schedule, for an update on letting us know where he thinks things are going to end, with year end and start of next year, please let him know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. As a reminder, if you are looking for some help if you're inspired to take action based upon what Jem's talked about here, obviously go check out his website and his firm and what they have to offer. But if you want to take action based on the many ideas that Jem put out here, highly recommend that most people, unless you're already highly experienced with these instruments and have a good track record of investing them, that you undertake that under the guidance of a good professional financial advisor who understands all the issues that Jem talked about here. Honestly, when you put that string of requirements together, the universe isn't really that large. But if you've got a good one who's being a good steward of your wealth that way, fantastic, stick with them. If you don't have one though, or like a second opinion from one who does, feel free to schedule a free consultation with one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me on this channel here week after week. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. And as a reminder, these consultations are totally free. There's no commitment to work with these guys. It's just a free public service that they offer. Lastly, just want to remind folks that the Thoughtful Money Fall Online Conference is fast approaching. Fortunately, the early bird lowest discount price that we're offering is still available, but it's not going to be available for that much longer. So make sure you go lock that in by going to thoughtfulmoney.com/conference. And you're the first ones, I think, watching this video to hear that we just had Fred Hickey of the High Tech Strategist sign on to be part of the faculty there. And he's going to talk about all things related to the AI trade. So he's basically going to pick up the baton that Jim just had there. So anyways, that should be a fantastic discussion. Jim, thank you so much. I'd love to give you the final word if you have any parting bits of advice for the audience.
I think going to be a volatile couple months. So keep your eyes on the markets, and look forward to chatting with you in November.
All right. Such a pleasure, Jim. Thank you so much. Everybody else, thanks so much for watching.